It's been 2 months since the Strait of Hormuz has been closed, and this single choke point accounts for 20% of global oil and LNG supply. The weirdest part, however, is that the reaction in the energy markets, specifically oil markets, has been pretty muted. The futures price of oil is hovering around $110 per barrel since the war started, and the dated crude price, the price at which a physical barrel of oil is transacted, is around $130 to $140 per barrel. Now, this price is high, but it is not abnormally high. While the situation at hand is extremely anomalous, as 20% of global supply just vanished overnight. If you compare the futures prices of today with the price hike we saw in 2022 when Russia invaded Ukraine, you will notice a stark disparity. When Russia attacked Ukraine, futures oil prices peaked at around $130 per barrel. But Russia accounted for only 3% of global supply at that time. Moreover, that 3% didn't just exit the system, it was rerouted to Asian markets, as European and other Western partners boycotted Russian oil. But Asian countries such as China and India bought more Russian oil than ever. So, what's the reason for this blunted effect this time, when this event is arguably more catastrophic? One of the most important factors has been that when the USA placed two battleships near Iranian borders, a record amount of oil was already at sea as traders were pricing in the probability of the conflict. This helped ease a direct hit on market supply as oil at sea is much more manageable. This oil can change its course as required, albeit at a higher cost of freight, but it is still better than sitting at a port waiting to be boarded on a ship. Second, we saw the 400 million barrels of the largest strategic oil released by member countries of the International Energy Agency or IEA, which has helped ease demand and therefore keep prices in control. But the situation is still gloomy as pre-war the world consumed approximately 100 million barrels each day. So at full demand this reserve lasts only 4 to 5 days. The final key factor has been the EV sector. The global EV penetration is around 25%, and it has reduced the per day demand of oil by 1.5 million barrels. The world is expected to have a surplus capacity of oil by around 2 million barrels per day by the end of this year or next year due to rise in EV penetration and also as global economies are not able to expand as quickly due to geopolitical uncertainties, which has reduced oil demand across the world. The alarming fact is that oil prices cannot remain where they are at present if the conflict drags on. The worst hit are the Asian markets, as they depend on the strait for 84% of their total demand. The Dubai benchmark index, in fact, peaked at $260 once, and after considering high freight and insurance costs, a barrel of oil is landing at an Asian refinery at around $170 per barrel. So the effects are already there and will soon